On September 15, 2008, Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy. Over the next few months, the U.S. stock market plummeted, liquidity dried up, and successful companies laid off employees by the thousands. It was at this time, when actors previously thought to be too big to fail suddenly plummeted, when the global financial crisis of 2008 was in full effect. Yet the roots of the crisis were actually planted years prior. The financial crisis was the result of the collapse of a bubble in the U.S. housing market. It was a gradual buildup of predatory practices and poor economic decisions that eventually lead to the downfall of the entire financial system. Here's how it happened. In the 2000s, investors in the U.S. and abroad were sitting on huge piles of cash looking for low-risk high-reward investments. Traditionally, these were used to purchase U.S. Treasury bonds, which were considered to be the safest of investments. However, at this time, these bonds paid very little interests, even amounting to a measly 1%. Led them to turn their sights on the U.S. housing market, thinking that they could get more payments from the interests that homeowners paid on their mortgages. But before moving further, here's how a mortgage works. Basically, a mortgage is a loan by a bank or any financial institution that a person can use to finance a purchase of a home. So, when a family wants a house that they cannot afford in a single purchase, they go to a mortgage lender that allows the cost to be payable for a period of, let's say, 30 years, in exchange for additional interests. The lender, or whoever holds the mortgage, is entitled to the homeowner's payments. When they fail to do so, it is considered as a default. So, this is where the investors step into the picture. Right after the papers have been drawn up, investment bankers swoop in and buy these mortgages from these lenders for a fee. So now, all payments and risks are transferred to these investment banks. However, it doesn't end there. These banks borrow millions of dollars to purchase thousands more of these mortgages in a process known as leveraging. This means that, monthly, they get all of the payments of the homeowners for these mortgages. But, as stated before, these contracts carry varying degrees of risks. So, what these banks do is pool together these random selection of mortgages into a box known as mortgage-backed securities or MDS. This is done through a risk-reducing process known as securitization, wherein even if one of these mortgages default, payments from the other homeowners would ensure that the intrinsic value of the security is preserved. However, because these mortgages take a long time to materialize, they are often considered as illiquid assets, which means that these banks are eyeing to sell of these loans along with the risks that come with it, as soon as possible. Additionally, because it is impossible to accurately predict which of these mortgages would go bad, the rating agencies that decided where investors should ideally place their money cannot rate these packages. And so, these banks transformed these packages into a complex financial instrument known as a collateral debt obligation, or CDO. This is where these mortgages are divided into three tranches or classes. We can identify them as the senior class, which is the safest, the mezzanine class in the middle, and the equity class, which is considered as the riskiest. How does that look like? Well, a good representation of it would be to look at a waterfall system with several layers. As money from homeowners pour in, the first level, or the senior class, is filled first. When all investors of this class have been given their dues, the money that continues to pour in spills over to the next class. Effectively, this means that once defaults occur, it would be the bottom level of the waterfall, the equity class, that would take the brunt of the problem. To counteract this, the bottom level has a higher rate of return while the top has a lower, but still good one. To make the top class even more secure for investors, banks will ensure that their dues would be paid in exchange for a small fee, which is an instrument that became known as the credit default swap, or CDS. Banks go through the duration of this process in order to grab better ratings from rating agencies like Fitch and Moody's. Ultimately, they gave the senior class a AAA rating, the best of the best, while they gave a BBB rating to the mezzanine class at the middle. For the last class, they did not even bother to rate such investments. Because of such rating, for the investors, they were able to say that they found an investment that was good for their money, much better than the 1% treasury bills. This led them to seek for many more of such investment opportunities. They went to the investment banks to buy some more. The investment banks then proceeded to the mortgage lenders in order to buy some more of these contracts, but they could no longer find anyone. Everyone who's qualified for these mortgages already had one. But then, they had a bright idea in mind. They thought that, In principle, even if some homeowners couldn't pay, which lead to a default, they would still be owning the house, which they could later resell at a price. At the time, this made so much sense because new lax lending requirements and low interest rates drove housing prices higher. And so, they decided to take on an added risk. If traditionally, only individuals who were able to prove that they could shoulder the expenses were allowed to take out mortgages, these banks now created a new type of mortgage that involved having no down payment, no proof of income, or basically, no document at all. At this point, these investors were no longer simply dealing with diligent homeowners, known as prime mortgages. Rather, they now had not so trustworthy ones, which came to be known as subprime mortgages. Without a doubt, this radical stance greatly influenced the turning point of the crisis. Every single actor in the chain never cared about the risks, because they knew very well that they would be passing those off to others. It was the same process all over again for the investors. However, this one became different. It wasn't just one or two houses that defaulted on their mortgages, several more followed, and this is a logical expectation to make, most especially when the subprime households never really showed signs of being able to repay these loans. This led to several foreclosures where many houses were put back to the streets. As such, when the supply became too much, housing prices started to plummet. Worse, as these houses lost value, people soon realized that they were paying for mortgages whose value was more expensive than the market value of the house they are actually paying for. And so, people walked away from their houses and stopped paying for these contracts. Many were forsaken regardless if the homeowner could still actually afford paying for it. Eventually, default rates swept the country. Now, the investment banks were basically holding a box filled with worthless assets. They started panicking because they could no longer repay the billions of dollars in loan that they made to package thousands of these mortgages because no one wanted to take their deals anymore. Additionally, due to the unpredictable nature of these investments, it was actually quite hard to report just how badly this affected some of these investment banks. This level of uncertainty ultimately led to banks refusing to transact with one another. Worse, they cut back on providing loans and credit to individuals on the ground. The lack of credit slowed down the firm's ability to make payroll and pay other bills, which played a major role in contributing to the recession which was starting at that time. The financial system was simply frozen in its tracks. Aside from international investors losing billions of dollars in the financial crash, this action reverberated across the world, with real estate prices going down from the Irish countryside and the Spanish coast to Baltic seaports and even in parts of northern India. These were primarily due to the tightening of home financing and credit in these parts of the world as a response to the catastrophe that started in the US. In Europe, their sizzling housing markets have cooled rapidly as nervous Europeans stopped purchasing investment properties. Even further east, China's stock market was in shambles and people no longer had as much cash left to plow into property. As governments across the world tried to get up on their feet through various bailout programs, the lessons of the crash were apparent. For as long as predatory practices continue to persist and economic bubbles continue to go unregulated, the world will never truly be free from the horrors of the 2008 global financial crisis.